And welcome back to the Friday Five after missing a week last week because I was off riding the white wave of life with my sons, which would mean snowboard trip to Okemo, Vermont for a long weekend. Back at it this week, and let's jump right in. Start where we always start with mortgage rates. VA 30-year fixed, 5.87%. FHA 30-year fixed, 5.85%. Conventional 30-year fixed, 6.19%. Conventional 15-year fixed, 5.76%. And then conventional 7-year ARM, 5.71%. So we're up about 0.1% from last Friday, even though I wasn't here to give you those rates. Slightly worse, but we are still in a pretty good place from a rate perspective. And I think we have a lot of customers interested in refinancing, and a lot of our customers that are out shopping for homes are pleasantly surprised or excited about where rates are. Hopefully they stay in this range, or maybe even we continue to see a little bit more improvement. Number two, I'm going to jump into a topic here that most wouldn't touch on social media. And yeah, I'm going to say it, the F word, fraud. So there's a lot of different types of mortgage fraud that can occur, but I want to focus on just one today, occupancy fraud. Now, historically, we've seen occupancy fraud occur when an individual says they're going to occupy a property as a primary residence, but they really are buying it to rent it out. And the reason that they would, kind of fib about how they were going to use the property is if it's primary residence, you can put less down, typically 3 or 5%, depending on if you're a first-time homebuyer or not, plus the rate's better. So that's what we've seen historically. Now we are kind of seeing the opposite. So with the DSCR loan, which is a debt service coverage ratio loan, where we are qualifying the borrower on the income from the investment property that they're buying, and that's what's used to qualify them for the mortgage. Essentially, if the rental income exceeds the mortgage payment, that's kind of how you qualify. There are people that can't qualify for a primary residence purchase because they don't have the income needed, and they're using DSCR products and saying, oh, I'm going to rent it out, but they really are intending to live there, and that's how they're getting around the fact that they don't have income to qualify. They just use DSCR. Some people may act like this is just a means to an end, but trust me, it isn't. It can have really steep penalties if you get caught committing fraud. Just Google DSCR fraud, Baltimore, Maryland. You'll see some stories. There also was some stuff going on down in Philadelphia as well. So please, when you apply for a mortgage, be honest. Make sure you qualify the right way with the right occupancy. And for heaven's sake, if you go to a mortgage guy and he's coaching you on how to commit occupancy fraud, please run the other way. You are not working with someone who is creative or a solutions guy. You're working with a crook. If you're going to buy an investment property, call it investment. If it's a primary, call it a primary. Don't lie about it on the application. Number three, in the fall or sometime late last year, there was an announcement from Fannie Mae, Freddie Mac that they were going to do away with their minimum credit score requirements. And I honestly, on my video, I think I kind of laughed it off and said, it's not going to make a difference. We're not going to get approvals through automated underwriting. So even though they relaxed their requirement, it's not practically going to make any difference. Well, boy, was I wrong. I'm willing to eat my words on that one. We are seeing the credit box opened up, hopefully in a responsible way. And there's two areas where I'm seeing it the most. One, if you have two borrowers on the loan and one borrower has a really high credit score, like let's say 760, and the other one maybe is like a 560. Those are some instances where we're still seeing the loans score as an approval through the computerized or automated underwriting system. The other one, which really excites me, and Dave Ramsey's going to be pumped about this one, is you now no longer have to have a credit score to get a conventional loan. So I have a customer right now, no credit scores, young guy, owns a landscaping business. He just hasn't used debt in his life. And I was kind of pessimistic that we would get any type of approval through the automated underwriting system. Well, 10% down conventional loan, a decent amount of reserves, and I got an approved eligible with no credit scores. It was approved through the automated underwriting system, which makes the process much easier. So that change that I thought was nothing actually is something, and it's pretty cool because I don't think, especially those people who don't use credit, they shouldn't be penalized for the fact that they haven't used credit in the past. It's kind of a good thing if you don't use credit, in my opinion. Number 4, with rates coming down, it definitely has created some interest and probably value in refinancing for some of those customers that are in the high 6s into the 7s. If you are considering a refi, I want you to look at all the numbers, obviously, on the refi, but pay close attention to these couple items. First, the new loan amount compared to your existing mortgage balance. If you're doing a rate and term refinance, which means you're just paying off your mortgage and rolling in maybe the closing costs or prepaids, you want to make sure that that new loan amount is not an exorbitant amount higher than your current loan amount. I'm seeing a lot of unscrupulous lenders who are charging 2-3 points to buy the rate way down, and then they just roll in those closing costs to the loan, and somebody may start with a $400,000 loan, and on the refi it's $430 because of all of the points that they're rolling in to make it look like a good deal when it's really not. Second, take a look at the interest rate and the APR and any points you're paying or rolling in. Again, you may think it's a great rate, but the costs associated with getting that rate may be really significant and may erase all the value that you may see in the refi. Number 3, look at the estimated value that the lender is using. Is it reasonable to what you think your house is worth in the market? Some lenders are estimating high value so that PMI isn't needed, but then when the appraisal comes back in, it comes in much lower, and then PMI is needed, and that can throw all of the numbers out of whack or erase a lot of the value of the refi. So make sure you look at the details because, unfortunately, there's a lot of lenders who are more concerned about doing a new loan and a commission than they are about whether the refinance makes sense for you and your family. And number 5, the idea or quote of the week, and this comes from James Clear in his weekly newsletter. There are 2 ways to grow, by adding or by shedding. Do you need to add something or do you need to shed something? I was talking to a buddy this week, and he's a branch manager with a different mortgage company, and we were talking about how there can be addition by subtraction. So you may have someone in your life who, from a mortgage perspective, like let's say it is a salesperson who does contribute some type of production value to the team. They have sales, but they are such a drain on resources that even though they are bringing production to the team, they may actually be decreasing efficiency within the branch and limiting some of the other team members from doing more production. So sometimes you need to add something, but sometimes you need to shed or prune for the improvement or the betterment of the team in the long run. Thanks for watching as always, and if I can help you in any way, please let me know.